Hey friends, Dan Passarelli here. How are you feeling today, guys and gals? All right, all right, all right. We've got great stuff to talk about today. I am super excited, but I want to make sure you can hear me. If you would, please make your way on over to the Q&A box, which I'm just pulling up right over here. And let me know how excited you are about today. Oh man, we're talking about high probability trades. And what's better than that? Well, it's a little bit of a trick question. So we're going to see. Please make your way on over to the questions box and tell me just how excited you are. Yes, John, I'm excited. Yeah, baby. Yeah, 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 yeah. Exclamations. Aslam, my friend, is here to show everybody up as usual. Boom, boom, boom. Shane, woo, hoo, ooh, ooh, ooh. All right, all right. Curtis, can't wait. I can't wait either. So, what do you say we get this party started? Now, before we get started, I do need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Don't trade with money you're not prepared to lose. And everything we're talking about here is generalized information, not specific to your situation. All right. Now, wait. Hey, who's here today? Who is here today? Hold on a second. We got to check this out. We got to check this out. I always introduce myself, but you're the important person here, right? So who's here? Who's here? All right. Bibble is excited. All right. Yeah, I see some of our old friends. I mean, not old like, this guy in this picture with all this gray hair over here. I'm talking old as in you've been here before. But I see some new names here too. And you know what? I like I like our, the family that meets up here every Tuesday. I like you. But I also like the new folks because you know what? You're indoctrinated into the family today officially. And I am happy you're here. Now, you might not know who I am just yet. So let's talk about that, shall we? My name is Dan Passarelli. I am an author of two of the most popular trading books, been part of a couple other books as well. And I'm working on my third uh, solo author books. Also, I'm a trader. I been there, done that, and I'm still doing it. Been trading since, oh my gosh, I started down the trading floor and I'm a little like not embarrassed, but like I feel weird telling you. I started in 1993. Do you believe that? I'm freaking old. Oh my gosh. Well, I guess that's better than the alternative, isn't it? So yeah, I've been doing this for a long, long time, over 30 years involved in options. So I've got some good stuff to share and you're going to like it. I'm also the founder of Market Taker Mentoring, which is the global leader in option trader education. Also, I collaborate because I've been in this industry so long, you get to know people. Like if there's anybody here in the audience who is, who's had the same career path, for like 30 years, I bet you know every darn person in your industry as well, right? Or at least a whole bunch of them. So yeah, you get to know a lot of people. And I'm really happy to say that I collaborate with a lot of the really, really good folks here in the options industry. Great options friendly brokers like Firstrade, a lot of actually just about every global exchange in the world, which is what global means. Also, I've been to the Hong Kong exchange, talking with them, Shenzhen exchange, Shanghai, all the ones in the all the ones in the U.S. As a matter of fact. So, yeah. Also, I do other things outside of options. I'm a family man. Those of you who are market taker mentoring students, I know you know my wife, Kathleen, who runs operations here for Market Taker Mentoring. She is the woman in charge. And I also have our two adult children who, they're like adults. They're in their like early 20s. I don't know. Anybody here have adult children? Yeah, let me know. Do you have adult children? Because I thought, oh, you do? Awesome. Okay. I thought that like when my kids were little, I thought that once kids turn 18, like, oh, you're done. I win. Oh, you have four, Michael? Holy goodness gracious. Um, yeah, I figured you turn 18, they turn 18. Hey, I won. I'm done. Whew. Okay. All that parenting stuff is over. That ain't how it works. First of all, they just keep coming back. My son came back after college to live with us while he went to grad school. My daughter went to Denver. She worked out there for a year. She came back to go to grad school, University of Chicago. She's very, very smart. My son went to, I'm in Chicago. I'm in Chicago. My son went to, Northwestern for undergrad, but then went to Loyola here in Chicago for a master's. Then he went to San Francisco out to work, and now he's back in Chicago going to medical school. He will be back in Chicago in about 6 weeks to go to medical school here in Loyola. So yeah, they just keep coming back, and I don't mean like if you have little kids, you're not gonna like that. The problems actually get bigger when they're older, but pretend I didn't say that and embrace the youngsters. Okay. Also, I do other stuff besides trading for fun because I have fun with trading, but I'm also a runner. I love food and wine and such. I'm a foodie. I can't help it. I like to cook. I like to eat. I love to travel. I do that with my family. Also do that as part of my role here with Market Taker. Been in a lot of different parts of the world doing that. And I'm a music person as well, or a musical family. All right, enough about me. Here, I got a little present for you here. Okay, we're going to be talking about high probability trades, and one of the main high probability trades that we talk about are credit spreads. So I have a present for you. Go to markettaker.com/guide, two T's in a row, markettaker.com/guide, and get my free ebook called Option Credit Spreads Explained, the easiest way to become a more consistently profitable trader. Now that complements everything we're going to talk about here today. So don't think that you can just like drop off the call here and read this. I got stuff that I'm going to talk about today that's not in that ebook. And there's stuff that's in that ebook that I might not talk about today. So do both. All right. But that, download it now, markettaker.com/guide. It's our strategy guide. Download it now, but read it later. All right, friends. Let's say a trader is studying Apple stock. Is that what this is? Yeah. And this trader thinks that it's not likely to rise above a certain point. Maybe there's resistance at like $230 a share, say. Well, the trader can position him or herself to make money as long as Apple doesn't go above $230 a share over the next 7 days. And they can do that by selling the 230 strike calls that have 7 days until expiration. And at the same time, as part of the same trade, also buying the 235 strike calls in the same expiration. So in this case, they sell the 235 or the 230 calls at $1.44. Buy the 235 calls at 47 cents. So this trader collected a net credit of 93 cents, right? 144 minus 47. Is that right? And John helped me with the PowerPoint. 1.44 minus 0.47. Well, 97 cents, excuse me. This trader collected a credit of 97 cents in this hypothetical scenario here. So 97 cents of option premium is $97 of money. Now let's say, so that's per one contract. Some of you trade options here, right? What's your typical contract size? 1 lots, 2 lots, 5 lots, 10 lots? Let's say, depends. I like that answer, Aslan. That's a good answer. Do you do it by risk? That's how you should trade credit spreads. Instead of saying, oh, I'll trade 10 lots, you should do it by the amount risked, the amount you can lose, and normalize it that way. I like your answer. So let's say, though, this trader traded a 10 lot contract trade. So if they sold it at 97 cents, that's collecting $970. Isn't that crazy how, like, you know, we're talking about pennies here, like change in your pocket, and all of a sudden, oh, no, you know, it's like $1,000. Well, that's how it works. So as long as this stock stays below $230 a share for the next 7 days, this trader can make up to $970 on this 10 lot trade and do so with limited risk because we're protected by buying the 235 strike calls. So think of it this way. The short option is where one makes or loses money. Okay? Like that's the point. Like each option in this spread has its own role, right? Like if you've ever owned a business or worked in a business and like kind of paid attention to how it operates, everybody has a different job. You know, there's the person who's on the sales floor selling the clothes or whatever it is. And there's the person who works the cash register. And there's the person who does the accounting. With any business, every job is a different role. And trading is a business. And kind of like each trade is its own little business deal. So each one of these options has its own role in this trade. Does that make sense? So the 230 calls, that's, I mean, they're both important, but that's the one where you're going to either make money or lose money. The idea is this is an option selling strategy where you're putting several things on your side. Okay? You're putting several things on your side. One of those things is time decay. We'll talk about that in a second. One is probability. One is volatility. There's a lot of things you're putting on your side. It's an option selling strategy. And so the 230 calls is where you make or lose your money. The 235 calls, that's the insurance policy. Or let's go back to the business analogy. That's like the armed guard standing at the door of this, you know, jewelry shop. Okay? Or the person who puts those little annoying plastic things that beep if the cashier forgets to take it off when you walk out the door. That's your protection. All right? If the stock is below that short strike, 230, between now and expiration, well, I mean, really, technically, if it's below their ad expiration, it can go through there and come back. But if it's below their ad expiration, you get the maximum profit. If it goes above it, you can start losing. Okay. And then the long options, what limits losses. Now we're going to talk about, there's a lot of caveats there. There's a lot to this. That's why we're doing a whole 1 hour workshop on it. Okay. So I am just going to jump right in. Think about your usual trade size. Okay. So again, maybe it's 5 lot, maybe it's 50 lot, maybe it's 1 or 2 lot. What if you knew a trade was going to be a winner, like the crystal ball scenario, right? Obviously, nothing's guaranteed when it comes to trading. Nobody knows if any trade you make is going to be a winner or not going to be a winner. But let's just say you had a crystal ball and you knew this trade was going to be a winner. Would you trade your normal trading size? Oh yeah. I'm a 2 lot guy. I don't risk more than $500 per trade. Yeah, if you knew for sure it's going to be a winner, don't you think you might trade it a little bigger than your normal size? What do you say? I mean, if I had a crystal ball and knew that a particular trade was going to win, I would mortgage my house, sell my car, borrow money from my friends, sell my dogs, my kids, get all the money I could and put it into that trade, right? Now, obviously, you don't know. I mean, there is no crystal ball scenario. But the idea is the more confidence you have that the trade might be a winner, the more inclined you are to trade it bigger. And that's how you make more money. So, like, before when I said, "Oh, what's your normal trading size?" and Asim said it depends, and I'm just going to guess because I think Asim's pretty experienced from what I pick up through our previous discussions. I'm guessing that you probably trade it based on the amount of risk, and like I'll do that with some of my trades in my smaller account where I trade live in front of our students with some of our types of trades. I'll risk $1,000 per trade, right? But on the ones that are much stronger trades, I'll trade them bigger. Yeah, someone says what I can afford to lose. Yeah, exactly. And like, just qualify that. If you have a $20,000 account, if it's limited risk, you can afford to lose $20,000, but not really, right? Like you might think, okay, yeah, I'm going to limit myself. I'm going to let myself afford to lose 1,000 or 2,000 or whatever it is. But if you just really love a trade, like it's very strong, in my classes, I'll do a bigger trade, more, maybe $1,500. If it's still a good enough trade to make, but not as strong as I'd like it to be, I'll trade a little smaller. And this is how you make money and how you size your trades. So I want to show you something right here. Nitsu says, generally $5 width, but had seen even a 20 delta trade going underwater at close to expiration. Sure. Yeah, of course. And the more you trade, the more crazy stuff you see. So let's take a look here. On March 17th, 400 call credit spreads traded in NVIDIA. So I developed a scanner that scans the market for when like big professional traders are putting in trades. Not putting in trades, but actually executing, making trades. So this is one of those trades that hit my scanner. On March 17th, 400 call credit spreads traded in NVIDIA. The stock dropped very big that same day where a big profit could have been realized. 4 days later, at the expiration of this trade, if that professional trader just let the trade expire, which we probably won't, and if we have time, we'll talk more about that. That trade could have locked in a $112,000 winner. That's a pretty nice 4-day profit. And that's a big trade, right? I mean, if it's like a $5 wide spread or something, you're probably not trading 400 of these call credit spreads. That is not, like Aslam said, something a non-professional usually can afford to lose. I mean, there's some very big non-professional traders who had a great career, maybe sold a business, and, you know, maybe they have a $10 million account. Okay, so maybe, you know, maybe you could if you have the confidence, if you have the chops and the skills and you worked hard on this. Mostly it's a professional trader. So this is a nice 4-day profit. Who is making these sort of trades? And it is the Wall Street traders. It is the professionals, the guys or gals who people are always saying are taking their money, right? But they're, you know, that's not really what's happening. You can, I mean, if you see a trade like this, you can follow along. Not trade 400, but trade 2 or 5 or 10, whatever your normal trade size is. Or since you know that it's a pro doing it, maybe a little more than usual. But pros lose also, right? So it's not like you would go crazy. So what I want to share for the rest of our time here together today is consistency. Okay? This is exactly designed with consistency and reliability in mind. Like nothing I ever talk about is some get rich quick scheme. And it's not like we're trying to get rich slow either, but you know, don't get me wrong. But we want to be able to make high probability, consistent trades. And high probability trades can lose sometimes as well. That's why we call them high probability trades. We don't call them high guaranteed trades. We call them high probability trades. What this is about drastically increasing your win rate with high probability trades to produce consistent profits over and over again, so that you have one part of your overall trading strategy that you can rely on no matter what and be able to manage them well. And consistency is not about guessing. It's measurable. It's using probability to increase your odds of winning and produce what we call in trading or in mathematics a positive expected return over and over again, or an edge. In order to do that, we've got to put multiple criteria on our side on every trade. And one of those things is time. So in option trading, time literally is money, or at least time becomes money. And the reason is because options provide more ways of making money than, you know, just buying a call and hoping the stock goes up. One of the most important ways is time decay. As time passes, options lose their value, which helps certain traders who know how to put time decay to use. Time passing creates money. And that last bullet point might seem counterintuitive, that time passing creates money, because a lot of traders, you know, just buy options. But hey, you know what? I like to say, if you can't beat them, join them. Put time on your side. Instead of buying options and being at a disadvantage, a lot of traders sell them. It's very, very common to do so. And in fact, selling options is actually more popular for the traders in the know than buying them, because it's a way to make money by time passing. You're putting an extra thing on your side. Now, one thing about selling options is if I just sell an option naked, like, oh, hey, I'll sell these calls. I could end up with a small profit potential, but a much bigger risk, theoretically unlimited risk if I sell a naked call. So we want to be strategic. There are two limited risk, very strategic option spreads that are at the heart of all option trading. And I actually call them the mother strategies of option trading. Look, if you're taking notes, write this stuff down. The mother strategies of option trading are credit spreads and time spreads. All right? Especially when it comes to selling options. I'm going to tell you something. If you can master credit spreads and time spreads, I think you can be an incredible option trader. And you know why? Because every other spread is made up of either a vertical spread, which is what, credit spreads are either, if you sell them, they're, well, vertical spreads, if you sell them, they're credit spreads. If you buy them, they're debit spreads. Two sides of the same coin. Every option spread, almost, is made up of either vertical spreads or time spreads. You master those two, you've got just about all of option trading mastered. So what I want to do now is drill down on credit spreads. So yeah, so Oslam says time spreads are diagonal spreads. Well, that's where I'm going with this. So a credit spread is this. There's two types of credit spreads: call credit spread, put credit spread. A call credit spread is when a trader sells a call, usually at or out of the money, and then buys a higher strike call with the same expiration on the same underlying. Okay. Put credit spread is when a trader sells a put, usually at or out of the money, and then buys a lower strike put with the same expiration on the same underlying. So the difference when it comes to credit spreads, which is selling a vertical spread, is everything's the same except two different strike prices. A straight time spread is everything the same, but two different expirations. A straight time spread, it's the same strike price. But this is what I was talking about. If you master credit spreads and time spreads, you've got everything mastered, because then you also have diagonal spreads, which is just a combination of a vertical spread and a time spread. A diagonal spread is when there's two different strikes and two different expirations. And yes, the time spread is the same as a calendar spread. Yeah, those are synonyms. All right, so let's get more into these credit spreads. So an important takeaway is that because there are both call credit spreads and put credit spreads, this method of trading credit spreads, you can do it in both up and down markets. And to be clear, these are not directional trades. They're not bullish or bearish trades. These are what traders call this is what I call line in the sand trades. A lot of people call them line in the sand trades. They're forgiving. As long as the stock stays on this side of the line, the trade wins. So with the call credit spread, as long as it doesn't go above that short strike price, really above the break even, trade wins. It can go up a little, it can go down a little or a lot, it can stay the same, trade wins. It's high probability naturally by nature. So let's go through some more depth here. This is what is called a probability curve, okay? We're like kind of drilling down on some stuff today. This is like way deeper knowledge than you typically get when people talk about credit spreads. But many of you are here week after week after week. You're getting the payoff for that. The horizontal, you know what I'm talking about when I talk about probability curves? If you don't, let's look at it. The horizontal axis here, this is the stock price. And the middle here is the current stock price. The vertical axis, this is the probability of the stock being at that strike price. So this is something like, if you've never seen this before, you really kind of need to think about a little bit. But this, if you get this, you're in very, very good shape. Because you know why? This is how professors think about stock prices. This is how the people who have created and create options pricing models think about stock prices. This is how algorithmic traders who trade options, especially, think about stock prices. They don't purport to say, oh, you know, I've got the secret. I know exactly when a stock's going to go up. That's not what professional traders do. They think about it like this. Now, what I have here is a bell curve. Most finance professors who, you know, really like getting technical and using fancy terms, they will say that stock prices are log normally distributed, which is a little different than this. A bell curve is not exactly correct, but I only got so much skill with PowerPoints, right? There's a close enough artist rendition. But to make it simple, here's what this shows. What they do is they take like the closing prices of stocks over the last month or so, and then they average them. And that goes here. Forget that this says current stock price for a second. If we're looking at the past, this would be the average stock price for the past month. But then they'll plot all the stock prices around it. You know, the ones that are a higher price go here, the ones that are a lower price go here. And it typically looks kind of something like this, but just a little different. It's technically log normal. But because investors have, or because professors and mathematicians who study this stuff, math intensive traders too, because they know that this is basically what it looks like, they use that to forecast future prices. So what they'll do is they'll say, well, the current stock price is here. So I would expect that in the future, about half of them will be here with a lot of them here, most of them around where the current stock price is. But, you know, even though most of them will be there, some of them will be there. Okay. Some of them will have bigger moves. And that's important because what that means is smaller moves are more probable than bigger moves, which if you've traded for a long time, you already know that. And another kind of important implication of this is that finance professors assume that a stock has right around a 50-50 chance of heading higher or lower. There's actually a little bit of a skew to the upside because of the interest rate assumption that goes into this, into a log normal distribution. Again, they're not predicting the future. They're saying, hey, look, on average, you know, stocks go up, stocks go down. It's about 50-50 with a little bias to the upside. If this was a year's worth of data, you know, there would be about an 8% bias to the upside because statistically on average, the stock market goes up about 8% a year, well, 10% a year before inflation. So yeah, they figure it's about 50-50 with a slight bias to the upside. That said, we want to take this and take all this mathematical knowledge that's been studied and proven over the years, and we want to change those, we want to use it to change those odds to be more in our favor. That's pretty exciting, right? You said you're excited about this. This is the exciting part. In this case, let's say there's a stock that's current stock price is 52.61. And maybe we sell the 54 strike calls and buy maybe the 56 strike calls. If we did that, we have a head start in making money. So let's look at that professor math. If the stock is at 52.61 and there's about a 50-50 chance of it being lower at expiration, slightly under 50-50 chance, that almost 50% chance of occurrences, these would be winners because you're staying under the call strike. Then for the other just slightly above 50% chance of the time, when it goes up, some of that time would be a winner also, right? Only if it's trading far enough above the 54 strike price at the time of expiration does the trade lose. That's why credit spreads are naturally high probability trades. Now, before we go into seeing how the trades the institutions are making, let's first take a look at what this looks like in real life. Here is a historical example, right? These prices are not current intentionally. These are not trade ideas. I just want to give you some examples so that when you see this, you might be able to do it. On September 20, here, let's pull this up here. On September 27th at 1:02 and 0 seconds p.m. in ExxonMobil, a big institutional trader sold 2,410 of the September 27th 118-120 call credit spreads at 62 cents. So that means the trader sold short 2,410 of the September 27th 118 strike calls, and at the same time, as part of one trade, also bought 2,410 of the September 27th 120 calls. Same expiration, two different strikes, selling the lower call strike, buying the higher call strike. Doing it at the same time, this is a call credit spread. Okay? Because the 118 calls are a lower strike, well, naturally they would have had more premium. Thus, the trader would have took in a credit when this trade was made. In this case, that was 62 cents a contract. 62 cents of option premium is 62 cents of actual money. Now, times 2,410 contracts, that's a lot of money. I mean, if this trader, who's a big professional trader, not what I would do anymore. I used to be a big professional trader. I'm not anymore. I trade in a retail account just like you. So this is not me. I'm not doing this. You're not doing this. But I'm showing you this so that you get an idea that this is what professional traders do, right? This is not just, oh, this guy on some webinar gave me some wacky idea. No, this is literally what professional traders do every day. And if the trader sold this spread, 2,410 spread at 62 cents and held it all the way until expiration, this trader could have made $149,420. Now, I'm going to steal my own thunder just a little bit. Chances are this trader didn't hold this all the way until expiration. Most professional traders close their trades early because, let's face it, if this trader could close it and take just $100,000 of profit and just get rid of the risk early, crazy not to do it, right? Aslam says, as a retail trader, how do we find out what professional traders are doing? Grab that strategy guide, that ebook that I showed you earlier, and read it. And when you do, I will actually send you a couple emails about a webinar that explains exactly how retail traders can find out what professional traders are doing. That's your first step, is to grab that ebook. Okay. Then you'll get the emails. So let's look at another one here. In Alphabet, parent company of Google, on September 19th at 2:04 and 52 seconds, 3,690 of the September 27th, 165, 167 and a half cent call credit spreads traded at 71 cents. So this trader sold 3,690 of the 118 calls, and at the same time, as part of the same trade, also bought 3,690 of the September 27th, 167 and a half calls. The trader took in a credit. Hold on a second. The trader took in a credit of 71 cents per contract. So this is a call credit spread. And its advantage is it's a not very bullish trade. Okay. It's not a bearish trade per se. It's a not very bullish trade. As long as the stock stays below $118 a share by expiration, if the trader held it all the way till expiration again, which again is probably not the case. They probably closed it early and took a smaller profit to reduce risk. But, you know, they could have made $261,990. Like that would be the full Monty. Okay. So let's talk about a couple of things here. I know some of you who have been with us for a long time have experience trading options. I want to talk to you folks right now. The ones who don't have a lot of experience trading options, you should pay even more attention because you're going to learn something great. So, experienced folks, what kind of technical setup, which means like what kind of pattern or whatever would we see on a stock chart, do you think we would want if we were going to put on a credit spread trade where, as long as Google doesn't go up above $165 a share by expiration, we would make money? Go to the questions box and type, boom, there's Aslam. Always Johnny on the spot. What kind of, and I'm going to ask other people. I mean, I think everybody can see your answer, but just think it through before you look at Aslam's answer. What kind of technical setup, what do you want to see on the stock chart if you're going to make a trade like this that makes money if Google doesn't go over $165 a share? And that answer is that there's resistance. The stock has hit resistance. If on the stock chart in recent past, when it's gone up to $165 a share, it came right back down, you've got an extra thing on your side. Sure, you've got time on your side. Nice, Adam. You've got time on your side. But if there's resistance there, that it tends to go down when it gets up to that level, now you've got yet another thing on the side that's not even part of the option pricing model. In a lot of ways, that's actually even more powerful as a criterion for setting up your options trade, your credit spread trade. Now imagine you see this trade the millisecond it happens, and you trade a 5 lot. Follow along. I mean, boom, on a 5 lot, you hold that till expiration, you can make up to $355. You know, this is hypothetical, right? This is a historical example. I'm not saying to make this trade. To the best of my recollection, I don't think I actually did make this particular trade. But just to give you an idea how powerful this is. Now, these are not super time sensitive trades as well. You know, like if you see this setup, it's not like, oh my gosh, I've got to make this trade in the next 5 seconds or else it's gone. You can see it 5 minutes later, 15 minutes later. You can probably see it an hour later, sometimes even a day later, and the trade's still valid. Because remember, like a lot of time, I mean, the most likely scenarios, the stock price has smaller moves rather than bigger moves. And in volatile markets, like if you're watching this live, markets have been kind of volatile lately. You see more big moves, but the market's not usually super volatile. So smaller moves are more common than bigger moves. The price doesn't change all that much over short periods of time most of the time. You make money on these trades by time passing. So you got time to, to do your analysis. All right. Anyway, let's look at one more. And I'll tell you what, you do see these trades every day. Right now, I can guarantee, I mean, I'm just going to look at my scanner on another page here, on another screen here. See how many credit spreads hit it today. 1, 2, 3, 4, 5, 6. And it's only barely lunchtime. So you see these darn things every single day. Every day. I could go open my Firstrade account, do some looking around, and I would guess that within a half hour, I'd find at least one call credit spread just looking on my own, not even looking at my scanner that shows where the professionals are trading these. So I'll show you one more example here, and then I'll open it up to questions. You can start putting your questions in the questions box now if you'd like, and I'll get to them as soon as I finish this example. So, okay. In Apple on September 24th at 3:33 and 8.759 seconds, that's down to the millisecond here, a big trader traded 354 of the September 27th, 220, 225 put credit spreads at 75 cents. Pretty big trade. And then 102 milliseconds later, 607 more put credit spreads traded at that same price. Geez Louise. Now we are getting into some big numbers. And then about 28 seconds later, 1,375 more of these traded at 74 cents. This is a 3 days to expiration trade. If the trader held this all the way till expiration, and in this case, stock stayed above $225, he or she could have made $173,825, which would be a pretty great trade. Again, for sure, they'd have closed this early, would have been less, but I mean, just to give you an idea, even a small trader who followed along, on a 5 lot, that's $375. But what I want to talk about here is this is a put credit spread. Okay, so talking to the experienced traders to answer, but the less experienced traders to learn from, what would you want to see on the stock chart if you're going to make a trade where if Apple stays above $225 a share by expiration, you win? What sort of setup would you want to see on a stock chart? Okay, got one answer so far. Anybody else? All right, same two folks as last time. Oslin and Adam both say there's support on the chart, right? Yes, there is support on the chart. Support means, let's see, what was this, 225? So right about here is 225. So, here when it got up to 225, it kind of hesitated. resistance becomes support. So here, when it got up to 225, it did hesitate, came back down. About the same thing here, kind of little coagulation here and here, here and here. So 225 bucks was a pretty solid support level for a while. All right. So these are just a few examples to give you an idea of how this all works. I'm going to put this back up to make sure people grab it. Let me answer some of your questions. Mark asks, how do you know, or what are the chances that the short call or put will get assigned? Great question. Great question. So remember I said that professional traders tend to close these early, not hold them all the way until expiration. Well, one of the reasons they do that is because if you can take a profit, now you get rid of the risk of the trade turning around and losing. When do you lose? Well, if the stock goes up through the, well, for a call credit spread, if it goes up through the short strike, for a put credit spread, if it goes down through the short strike. Technically, there's a break even that's a little more forgiving. With the call credit spread, it's the short strike plus the premium received. With the put credit spread, it's the short strike minus the put net premium received. So you are likely to only get assigned if the underlying stock, or no, if the short put, or, oh my goodness, let's start this over. You're only likely to get assigned if the short option is in the money. You would never exercise, I mean, if you were long a call, you would never exercise your right to buy the stock at a higher strike than where the stock is. You would just buy the stock at the cheaper price. With the put, you would never exercise your right to sell a stock at a lower strike than where you could just sell it without using the put. Only if the call is in the money, the stock is a higher price, so you can buy it at the lower, or the put is in the money, you can sell it at a higher price instead of the lower, would the long exercise. We're on the opposite side of that, being short, so we would get assigned. So that's only if it's in the money. Now, once the trade is in the money, like you're probably not super likely most of the time to get assigned as soon as it goes a penny in the money. Usually, it's got to go far enough in the money where it's worth exercising, where there's very little time premium left. But here's the rub. Not the rub, here's the advantage. The trade starts looking lousy once the short option is in the money. So putting your risk manager hat on, being a good trade manager, what I do is I just set a rule where if the underlying stock goes through the short strike and that short strike becomes an in the money option, I close it right then and there that day. And then I'm very unlikely to get assigned. Once I close it, I can't get assigned. Now, sometimes when the trade, like when the short option gets in the money, I end up losing. More often than not, if the short option goes in the money, I end up losing. But it's usually a small loss at that point. You don't hit the maximum loss until both options are in the money. It goes so far through the short strike that it even goes through the long strike. When that happens, you can start hitting your maximum loss. You usually don't unless you're close to expiration, where there's no time value left in the spread, or both are so deep in the money that there's no time value left. So I like to close them early, and I'm very okay taking a small loss on these. You know why? Because most of the trades work out and become winners. So if I'm taking profit, profit, small loss, profit, 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 small loss, profit, 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 small loss, profit, 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 I've got a pretty good recipe for success, don't I? So the way to avoid, the way you can usually avoid assignment is close it as soon as it's in the money. Now, if there's just a gigantic gap through the short strike, it's not impossible to get assigned that day. Like when the market opens, like if it just gaps massively through, both options, you might get assigned, but you're still protected by the long option. Good question, Mark. Garish says the risk is high. $5 spread for only 75 cents. The probability has to be very high. Great, great comment. Because yes, when it comes to option trading, there's always a trade-off between the probability of success and the risk reward. The higher the probability of success, the more risk per reward there is. The options pricing model balances this out. So one of the things that I talk about in the credits in this strategy guide or ebook is that balance, and that you have to put this extra edge on it, which is explained. It was not explained in, well, I think it's a little bit explained in the strategy guide here, but it's very explained in the webinar that you'll get an email for. So that's a very valid point. Some people who are not good at these trades, they make a little, lose the whole time. Make a little, lose the whole time. So we never want to do that. I mean, sometimes you can't avoid it, but usually you can. Very good question. What type of chart should I consider looking at? I always look at daily candles over a 6-month period. How can I find the details for S&P 500's index? I mean, there's different methods for doing that. There's SPX, there's SPY. I don't know. I'm not sure which ones of those you can get on Firstrade. Just, look around, Google different symbols, maybe ask the folks at Firstrade which ones are available. Awesome says, just downloaded the book. It's only 12 pages, good read. Yes, for me, like, I don't like spending hours and hours reading something, I mean, if I do, I'll read like a full cover to cover book, which I'm in the process of 2 of them right now. So I like to keep these right to the point so you learn a lot in a short period of time. What is the best way to identify, what is the best way or tool to identify credit spreads or naked credit calls or puts? If the flow is usually a multi-leg and it's still difficult to decipher depending on chart time frame you're looking at. So if it's a debit spread at support, yeah, there's a lot there. Grab the strategy guide and open the email that invites you to the webinar. There's more in there. And we're at the end of our rope here, but following unusual activity is one thing I do. I talk about seeking out support and resistance, which, you can make it labor intensive and flip through a bunch of charts. Osm says, I do XSP. It is affordable. Yeah. That's the 1/10 size of SPX. Sandy says, how to scan to know the big volume credit spread. I've got the scanner. Yeah, download the ebook, open the email, watch the webinar. I explain everything in there. All right, folks, great questions. You guys were great today. And like just about everybody stayed till the end. You guys are awesome, man. So I'm going to see you next week. Next week, we're going to talk about approaches to trading corporate earnings. Oh boy, because that's like a week before earnings season. Mark your calendars for that one. That is like my favorite topic to talk about. Oh my goodness. So, all right. That said, friends, have a great rest of your day. Trade smart, and I will see you next Tuesday. Bye.